Good afternoon, ladies and gentlemen. Welcome everyone to today's forum of the 2023 FX and Macro Outlook. We are excited to organize our very first event for 2023 at the historic building of the old Athens Stock Exchange. As we all know, the foreign exchange market is constantly evolving and can be impacted by a wide range of factors, including economic conditions, political developments, and global events. As we look further ahead into 2023, it is important that we take a comprehensive and informed approach when discussing the outlook for various currencies and the foreign exchange market as a whole. Today, we will be examining the current economic conditions, political developments, and global events that are likely to shape the foreign exchange market in 2023, and discussing the potential impacts on various currencies. For all that, we will hear from three experts in the field who will provide their insights and analysis on the current state of the market and what we can expect in the coming year. I would like to thank everyone for joining us today, and I look forward to an engaging and informative discussion. I'm Yanos Kontopoulos, ATHEX Group CEO, and I did not write this. My head of communications did not write this. This is all chat GPT. But I can guarantee you that whatever will follow in the next hour cannot be done with ChatGPT or any other generative artificial intelligence. And believe me, I tried. I got garbage back when I asked for an outlook for 2023. Now, for that, we're going to need actually three leading experts here. And I'm going to start from all the way at the far end. We have Themos Fiotakis, Managing Director, Global Head of FX, NEM, Market and Macro Research at Barclays. Next to him is George Saravelos, Managing Director, Global Head of FX Research at Deutsche. And last but not least, right next to me, Thanos Vamvakidis, Managing Director, Global Head of G10 FX Research at, I think, covered the US, UK, and I think we are ready to go on. But look, I'm not going to bore you too much with the CVs, primarily because you have their bios on your desk. And also I'm going to save all of us the unnecessary envy of having to listen to what these guys have done over the past few years. But I would like to say that these three folks, probably pound for pound, are one of the most valuable exports of Greece right now. And why is that the case? Because on a normal day, these are the go-to people and the teams that they lead for general strategy advice for their own banks. And actually, even more importantly, when the proverbial economic and geopolitical manure hits the fan, and under the fog of war, somebody needs to come up with an analytical framework and an analysis to answer questions on, take your pick, Brexit, the election of Trump, the invasion in Ukraine, the Greek plebiscite. These are the guys that get the call in an ungodly hour, and they have to react to it. So I want to thank them for being here today. I should also add that, at least from my personal experience in the last 10, 15 years, these guys have been particularly helpful to Greece in ways that I'm not going to mention. And also that I think we should be feeling privileged because, forgetting about who these three guys are, but the level of seniority and their specialty, the fact that they're competitors and we got them all together here is actually a rare event. So I hope you enjoy it. I hope it helps you in your business. And I hope you get to use the time that we have here efficiently. Now, some last logistics. The discussion, as you might have surmised, is going to be in English, as we have some non-Greek participants joining us today. In about 45 minutes or so, I will open the floor so you get the opportunity to ask questions, and I strongly encourage you to do that. Feel actually free to ask questions in Greek or in English. Μπορείτε να ρωτήσετε ερωτήσεις στα ελληνικά. As we finish with the Q&A session, I will invite you and you'll have a chance to meet all of us and meet with each other with some Greek tapas and some drinks. Finally, I would like to say that the event is actually broadcasted live, and we have people joining us online from both Greece and abroad. So without further ado, I'm just going to get started with the first question, and it's not going to be a very deep one, but I want to make sure that all these guys here get their money's worth. So I'm just going to ask you, without actually giving us a justification, to give us your year-ahead forecast for euro-dollar, any estimate that you have of an equilibrium on euro-dollar, and your confidence around both of those estimates. And we'll leave it at that, and then the subsequent discussion should give us enough of a background here. So I'm gonna start with Thanos. I just need numbers and confidence levels on euro-dollar. So these guys can go say, they can leave now and say, we got something, we're out.
Well, first to really thank you for this invitation. It is really a privilege being in this event and in this gorgeous room. And I'm really looking forward to an interesting and lively discussion. Now, starting with our forecast, our end year euro-dollar forecast is 110. For next year, we have it 115. But it's not that boring, actually. In the short term, we see renewed dollar strength. So we believe that by the summer, euro-dollar will go down to 105 or even lower before appreciating again. In terms of confidence to this forecast is relatively low because, as I will explain in our discussion, on the one hand, the dollar is still overvalued, but on the other hand, there are too many moving parts and substantial uncertainty about the inflation path that could lead to more FX volatility beyond our forecast.
We'll talk about that. Don't give any anything away. How about the equilibrium? What's the equilibrium?
Now, our equilibrium estimate for euro-dollar is about 120.
Okay.
And this is broadly the historic average.
All right.
There is a view that maybe should be lowered because of what is going on in energy, but for now we keep it there.
All right. George.
First of all, thank you also, Yana, for inviting us. I have to make a special mention of the geographic representation without upsetting Themos.
Okay.
Because we're all three from Thessaloniki. So
all right. Power to power.
Thessaloniki is a special export in currency.
I don't know, what team are you supporting? Are you supporting any Thessaloniki team or?
It has to be PAOK, of course.
PAOK, okay.
Aris.
Iraklis. So we covered everything. Okay, we're good. This was not staged, by the way. I didn't know the answer, so good. So go to euro-dollar. It's going to be a harder one.
So euro-dollar, we're a bit more optimistic than Thanos. We think by next year 120, above 120. Medium-term fair value around 125.
Okay.
Confidence level, again, when there's a war happening in Russia, Ukraine, it's hard to have very high confidence, but I would say it's higher than what it was last year.
All right. I've been working long enough with Themos that I think I'm going to hear a high level of confidence there. Themos, give us your answers.
First of all, thank you so much for the invitation, and thank you to everyone for investing 40 minutes of your time for having a conversation with us. I don't think you're going to hear something massively different from me. We have our year-end forecast at 112. I think what is interesting is to know that around November, we revised it from something like 103, 104 to 112. That change is massive, which tells you how big the events that are driving this. And therefore, if someone says that they have confidence on their actual tools, but the developments that are driving these things are quite random at this point in time, and I think it needs to be acknowledged. What is fair value? I think something around 110 to 115 is fair value, but we have an assumption that energy price will remain an issue, and that is weighing on that fair value.
Okay. All right. Fair enough. So we got something. Well, let's build on that by taking a step backwards and start, talking about the backdrop for a little while before we get to the further prognostications. So let's start with inflation. Inflation has been the big surprise for the markets last year. It has now peaked. Should we be even talking about inflation? Is the worst over? Let me start with George this time. Now you can add a little bit of context here, whichever way you want.
So I think the first additional question we have to ask is which country? And the inflation dynamics are really starting to differentiate. In general, I would say yes, the worst is over. If you look at emerging markets, the weight of food and energy is extremely high. So even from a mechanical perspective, the impact on inflation expectations is going to be bigger for emerging markets. So that would be the area where we're most confident that the problem's over. In the US, the way we look at it is break it down into three baskets: core goods, housing, services ex housing. Core goods is already in deflation. The dollar's been extremely strong. Supply chains are being resolved. Housing, the US housing market's collapsing. So all the forward-looking measures of rental inflation are coming down. The last big one left is services, which is basically wages. And here it's starting to improve, but the pace of improvement in terms of the labor market easing, I think is still under debate, and I'm sure we'll debate that. So I would say in the US, we're getting there, but we're missing one last bit. The euro area is, and this partly drives my more optimistic euro view, the euro area is one place where I don't think we have the all clear at all. If you look at the euro area, core CPI is at record highs, the unemployment rate is at record lows, and it looks like the labor market's reaccelerating. You have very easy fiscal policies, and equities are back at record highs. So I'm most worried about European inflation.
Okay. Famos.
So I'll start with stealing a little bit of Thanos' thunder.
Okay.
When I was his client and I was investing money a year plus ago, I heard Thanos as one of his lectures here saying, Europe has supply-driven inflation, cost inflation, whereas the US has demand inflation. That last year was seen to be as a reason to think that US inflation is more sustainable. I think this year it's the other way around. I think this year, just because of how much the Fed has raised rates, US inflation is going to collapse, in my opinion. And I think Fed will cut rates, and that will be positive for risk. I do think that European inflation is very sticky, partly also because of how Europe operates. For instance, once rents increase in Germany, because of rent control, you cannot raise them all in one go. They need to be raised in stages. So for 2 or 3 years, you'll be seeing rental inflation in Germany, as opposed to 6-9 months, which is in the US, those lags. Beyond that, though, I do think also that with China reopening, natural gas prices and oil prices will need to increase a lot. And while that's, there's a lot of buffer in the United States, I think in Europe that we have very little space for the additional reason that rates are still very low.
We'll get to that. We'll get to the policy framework. Panos.
I think inflation will be sticky everywhere.
Okay.
Now, honestly, I don't really care if inflation is somewhat higher in the Eurozone or in the US. Where I have a strong view is that inflation, not only this year, even next year, is going to be well above 2%. And I don't know if it is going to be 5% or 4% or 3%, but well above 2%, so that you're not going to have central banks pivoting anytime soon. Now, why we believe inflation will be sticky? Well, core inflation is already sticky. Headline inflation is falling because energy prices are falling. I agree with Amos, energy prices are going to increase to a large extent because of China's reopening. And for bottlenecks that were there even before the war in Ukraine, the labor market is stretched everywhere. What is really shocking, in every single G10 economy, regardless of anything else, you have the lowest unemployment rate in the last 40, 50 years or ever. And wages are already decreasing everywhere, not at the headline inflation rate, but at the core inflation rate. And fiscal policies actually lose everywhere.
Not in the US.
I'll talk about that. I will talk about that. I think fiscal policy is extremely loose everywhere. And what is shocking, the market is still pricing inflation to drop all the way to 2% by the end of this year or early next year.
But I guess you wouldn't be using inflation as a differentiating factor driving euro-dollar, for example.
Not really. To me, what will matter when central banks and the market realize that you're not going anywhere close to 2% anytime soon, central banks will have to face very difficult dilemmas because they have to ignore recession risks or actual recession to focus on inflation. They may have to deal with blind spots that will come up. We saw the LDI crisis in the UK, and their credibility will be at risk.
So let me just move on to, I guess, one related question as the backdrop of what we should be thinking that relates to how do you stop inflation? Since you're the most strong advocate here. Would it take a recession to actually stop inflation, to put it down, or are we going to get a soft landing?
Now, when you look at the labor market today and headline inflation, you say that's a soft landing because headline inflation is falling without unemployment increasing. When, however, you look at PMIs and core inflation, this is stagflation. So forward-looking data are already raising red flags. Now,
Famos is getting agitated, I think.
It would be an interesting exchange of views. I mean, when the unemployment rate everywhere is so much lower than the natural rate, you need the labor market to weaken by a lot to expect that it will help bring inflation down from a very high level. So yes, most likely we need the recession. And the problem I see is that at this point, the central banks are the only ones that are trying to bring inflation down. We need fiscal policy to help. We need structural reforms to help, which they don't see as their job to address the inflation issue. So there is actually the risk that you may over-tighten, you may cause a recession that might be deeper than necessary just because you don't have any policy coordination.
Okay, all right. Anything to add on that front, on the recession linked to inflation coming down or lack thereof of that impact?
I think the very important point here is fiscal policy, and maybe a source of difference of opinion with Thano is when we look at the US this year, we see the risks as heavily skewed towards very tight fiscal policy. And there's a simple reason for that, which is the debt ceiling. The debt ceiling has already been hit. Now you have divided government. If you look at the last two big fiscal tightenings in the US, 1995, 2011, it was the same setup. You had the Republicans pushing for a much tighter fiscal stance. Now, the market is already pricing the Fed cutting rates this year. Is that entirely unreasonable? The market is a probabilistic animal. It looks at probabilities. If you're in a situation where the debt ceiling causes extreme fiscal tightening, which it may do because the Republicans have power, the US goes into recession not because of the Fed, but because fiscal policy is tightened very aggressively, which is a very different picture to Europe, where fiscal policy is easy. So I think, yes, you do need tightening to get inflation under control, but it's possible this year it happens with fiscal policy. And one reason why the market is pricing a dovish Fed is it's pricing that probability because the Republicans are saying they will cause a crisis.
And this is an event in August, do you think?
It's hard to time exactly. We think it's somewhere between June and August. But I would emphasize it's a very, very big event. In 2011, it was a very big event for the market. It led the Fed to do QE again. It actually did the Operation Twist. So I think it's a very important thing to watch on the calendar.
I do agree, but fiscal policy in the US is not tight yet. And what are you assuming about the EU fiscal rules?
So I agree it's not tight yet. I guess what I'm saying is the risk is you have a big risk of a very big, and the market has a price on probability. Now, Europe, I think, is completely different. And here what we're seeing is the governments have budgeted spending with natural gas prices at 200, 300. Now prices are at 70. What are they going to do with that money? They will still spend it. And that is a big additional fiscal easing in Europe this year. And that's where I see a bit more divergence, because in Europe, you're still seeing easing, while in the US, the debate is shifting towards tightening. For me, that's more divergence.
All right.
So I think that us economists are a little bit disingenuous. We tend to have or portray this causal link that says wages generate prices. And we tend to portray it as if this is an axiom, something that actually happens. If you look at the actual data over the last 20 or 30 years, there's very little link between prices and labor markets. And what is more interesting is that the things that the Fed is looking at, like service inflation ex housing, is even less correlated with labor markets. Even if you try to squeeze the data as much as you can, and you still say, all right, a lot of people have jobs, this will raise price to some extent, you're still talking about an increase in inflation, which is small. How we got into this huge inflation of the last year, it was not just the tight labor markets. It was also the speed at which we recovered. There's something known as speed limits. You're asking people to go out of lockdown and then find jobs in the services industry. You had a massive shock to transportation of goods, which is now abating. If you look at the Baltic Dry Index, it's collapsing, literally. You had what is known as revenge spending. We spent 2 summers at home. The 3rd summer, we used all our savings to go on holiday at any cost. That's not happening for the 2nd year in a row, mostly because we spent that money. So you're seeing now hotel prices and airline prices starting to come off. And then you had a massive asset bubble, which created a housing overpricing, which raised rents across the board. Particularly in the US, rents are coming down. So if you look at the bottom up, a lot of pricing mechanisms are cooling down. And to me, I think it's very plausible that we end up in a place where, as Thanos says, we're above in target, but not massively above target. And what that means, let's say we have US inflation at 2.5. Will the Fed be raising rates with rates at 5 plus? Probably not, particularly if you have a meaningful probability of a growth shock. So to me, I think the other components that shook inflation, we used to call it transitory, we have completely let that go and forgotten about that, are at play. They're at play very vividly in the US, less so in Europe, and I think they're very important for the asset spectrum at the moment.
Okay. Well, let's try to bring this all together to policy. So let's crystallize that view in terms of which central banks can afford to pause or even cut rates or even hike, above and beyond what is actually priced in. Whether the Fed and the ECB could be different. Are they different? Will they have a chance? And how high would we expect? Because I'm going to take that bias from what you said for the ECB to raise rates with what you know so far and what you're projecting, and whether that is going to last for a moment or would it be sustainable? Because I think there is a little bit of a bias, less so for you, Thanos, that the Europeans have to move a bit more aggressively. And I think to some extent is also reflected on the margin in what the markets are pricing. So against what the markets are pricing today, what is interesting about that policy divergence, if any?
For the Fed, we have a terminal rate 5.25%, slightly higher than market pricing, but not that different. For the ECB, 3.5% with risks that might be higher, but the market is at 3.25. So basically, we have 125 bips hike more than the market's pricing for both central banks. Where we disagree completely with market pricing is the cuts. Of course, you can think of a lot of risks that can happen to force central banks to start cutting, but not in the baseline. So the scenario that we see, they both pose at some point in the first half of this year, and then they give some kind of forward guidance that interest rates will remain at these levels until inflation is sufficiently low. And we can discuss what is the threshold, but I don't think the central banks know. We're so far above the target that this is a debate that they're going to have when they reach this point. Now, the ECB now is more aggressive than the Fed because they have a lot of catching up to do. I mean, last year, the ECB, they were in denial. I mean, they were doing QE until June. They wanted to start hiking very slow. Inflation kept surprising to the upside. The market was pricing much more. Their communication was all over the place. I mean, since December, they got it right. Since December, we have a clear message from the ECB. They will do whatever it takes to fight inflation. Talk is cheap. Now they've done it. Now they have to deliver. They will be hiking faster than the Fed. But again, they have to catch up. The Fed pivoted towards this direction much earlier than the ECB.
So the Fed is not going to cut. That's one of the headlines
Absolutely
here.
Not this year. And honestly, although the House views that they may start towards the end of next year, I would put a question mark to this one as well. The ECB, absolutely not.
All right, let me jump to Thamos and then I'll rotate back to George.
I think the Fed will cut.
How quickly?
I think by the end of the year, they're going to cut, at least twice in our forecast, or once in a big step. I think we have all forgotten that 5% rates is high. I think that although it's not visible in the labor markets, there's a lot of signs that other domestic sectors in the US economy are slowing. And if inflation continues like this, I mean, let me remind people, for the last 3 inflation prints, core inflation in the US outside of housing came negative. This didn't happen in COVID even, right? And we know that housing inflation, which is the only core inflation component that is high, is going to collapse to about 0 in the next 3 to 6 months. So unless inflation really accelerates from what is printing now, you will have a Fed that has a level of rates which is miles above inflation. And regardless of whether the economy is slowing or not, but especially because the economy is slowing, they will need to adjust rates even technically, let alone they could do it more meaningfully. I think that Europe stands at a sharp contrast. We have been muscle trained in the same way that with trauma, we got to understand that the Fed can raise rates to 5%, and we're now anchoring to that. I think in Europe we have been trained over a decade to think that rates will not go up. And the moment that rates go up, the universe implodes. The reality is a very big truth, which George has said. Fiscal policy is different in Europe this time around. It's not different just now. It's going to stay different because Germany is facing the problems that it was facing 20 years ago. It's facing competitiveness problems. A lot of companies are leaving Germany. It's facing problems with its export markets, the substantial protectionism trends both in the US and in China. It's facing energy transition and security issues. Yes, we are reducing our dependency on Russia, but we're increasing our dependency on Qatar. We're increasing our dependency on the Middle East, which are all very unstable places. So the exit is only through investment in things like nuclear power, et cetera, that will take a lot of years and a lot of deficits. And lastly, defense spending throughout Europe is a huge development for the next few years. And I think that in all those counts, Germany is slipping into deficits, and it's going to be hard for Germany to impose surplus policies or tight fiscal policies to the periphery if they are in deficit. So we have to calibrate to a Eurozone that runs deficits. And that's a place where rates are higher on average. Inflation in Europe as well, not just now, but also in expectations. Inflation expectations in the US have not increased much. In Europe, they're now at levels we haven't seen since pre-GFC, basically, right? 5-year inflation expectations, which makes rates look smaller than they are actually, lower than they are actually. And within all this, what you have is that there's quite good evidence that the economy hasn't slowed down despite the hikes, not even financially. Financial markets are doing quite well, partly because China is reopening, and we know that China is a big growth driver for Europe. So OECD estimates that China pass-through from China to Europe is something like 30 basis points or 40 basis points. China is going to have a sequential acceleration of growth near 6%.
I'll go to China. We'll go
So
there too.
all of these things, probably the ECB has told us they will go to 3. The market is pricing the bare minimum. I had a chat with Peter Pratt 2 weeks ago. I mean, he's no longer the ECB, so his personal opinions, etc. But the mindset in Europe is 3 is the absolute low scenario. And something between 3 or 4 is a lot more in the cards. And I buy that.
All right. George, what would you add, or what do you think is the surprise either way,
So,
policy-wise?
2 comments on the Fed. Number 1, I have no idea what they do this year. I think the Republicans will tell us what they do.
Okay.
Number 2, when the Fed decides they cut and they've done their job, they will cut by more than what the market's pricing. Because we have to keep in mind, rates of 5% are extremely high. They think neutral rates are somewhere around 2.5. So when they decide job is done, inflation's back down, they will cut 200, 300 basis points very quickly. And this is what the market is struggling to price, because the market always tries to price things linearly rather than wait and then a big cut. So I think some of that market pricing is distorted. So stronger view on the size of the cuts rather than the timing. On the ECB, I think the risks are 4% rates.
For when? Just terminal, but when do you think they get there?
by the summer. So they keep going 50s beyond March because, you know, imagine we're in a room, this is a university, and I give you an imaginative economy where the unemployment rate is at record highs, wages at record lows, unemployment at record lows, wages at record highs, core inflation at record highs, equities at record highs. The BTP Schatz spread, so this is the 2-year Italy German spread, is 30 basis points. When I was trying to convince people last year the ECB would go to 3, all the Americans would say Italy will blow up. Actually, I was in Milan 2 days ago and all the Italians are happy because no one has a mortgage. Italy, Greece, the last 10 years, everyone's been deleveraging. So the impact of these ECB hikes is not as big as people expect. So I think 4% is very possible.
All right, let me make a mini public announcement. You'll know, I mean, I think you're starting to understand that tonight and for the whole of 2023, a Greek will be right. You know, everything we discussed. But the way that I would urge you to think about it, it's not that we, you know, everybody said something different, which they didn't, but rather to think about the scenarios, right? That on how things might play out, because I think that's might be the most helpful aspect here. Let me pivot on something that probably most of you won't care. So that might be my bias, not because I have lots of investment in Japan, but I think that potentially it might matter. And that relates to the BOJ having surprised markets with a change in their yield targeting policy during the holidays, which has been around for a long while. And they have been pushing against speculation for future changes since then. So that's now we've engaged in a battle between the policymaker and the markets. The first question is who will win? And more importantly, because then it's going to be the wrong question, are there any global implications? Should anybody here, if they don't have any exposure in Japan or the yen, should they care about this? I'm going to start with George. Sorry, I'm just trying to rotate here. What about BOJ? Anything interesting there?
Okay, so I have no idea what Kuroda will do. He's playing a multi-dimensional game of chicken with the market. He decided to hike rates in December when all the hedge funds were on holiday. And a week ago, all the hedge fund managers woke up at 2 a.m. because they thought he would move, and he moved the other way. But either way, he's going. In 2-3 months, he'll be gone. So for me, the big question is, have we seen a regime shift in inflation in Japan? Because the Japanese have lived in deflation for 40 years. Asset allocation in Japan, everyone is used to 0% inflation. If you believe that has happened, as we do, then the implications are huge, because the Japanese will have to live with 2% inflation, much higher nominal rates, potentially higher real rates, higher rates of return on equities. We think the big global impact is going to be a repatriation of Japanese cash back into Japan, a much stronger yen. Globally, it should mean, because the Japanese are very invested in bonds, especially in Europe, actually, term premium higher, so steeper curves. But we think that effect will be gradual because the Japanese have already sold a huge amount of bonds in preparation for moving back to Japan. May I make one last point on the Bank of Japan? You asked who will win. There is no market at the moment of Japanese government bonds. The Central Bank of Japan owns 110% of the 10-year bond. How is that possible? They own 100%. They lend them out to speculators who borrow them from the Bank of Japan and then sell them back to the Bank of Japan. So the market is broken because the BOJ says the price is here and the market says the price is here and nothing ever trades. At some point that will get resolved.
I'm going to challenge you for this just a little bit, okay, for
Please.
a second. Okay. All right. You say huge implications for Japanese assets, but not necessarily globally. Let's draw this a little bit. What is your dollar-yen forecast for year-end?
So we have it at 115, but eventually I think it could go below 100.
I mean, what's the horizon?
Next 2 to 3 years.
Next 2 to 3 years. That's a huge move in FX terms, right? We are at 130. All right. So I've learned long and hard, but I'm going to ask the other two folks here that when Japan goes through something, because you're describing something that's a paradigm shift here, right? We should be paying attention. But what you're saying is that this is, to a large extent, a Japanese story at the end of the day. It won't necessarily trickle down in some sort of a very meaningful fashion, at least this year. Is it a fair assessment?
I would say it won't be a systemic event. It will have an impact, but it won't blow the world up.
All right. Well, those two are a little bit far apart, but how about Thano? What do you think?
We are broadly on the same page. I mean, the first thing to note is that what the Bank of Japan is doing is not sustainable. Yield targeting.
So the market will win?
I think so, because I think even the Bank of Japan is telling us, let's wait to see what happens with inflation. And if we are right, inflation will remain in Japan as well above 2%. So there is no reason to have unconventional monetary policies. So they will get rid of yield targeting, they will bring rates to zero. Now, the big question is, do they need to start a proper policy normalization cycle or not? If they don't, then this does not have global implications. But the market will win because the Bank of Japan is in a battle that is just, will not end in their way. And in a way, they opened Pandora's box with what they did during the holidays. I think it was a mistake last year. They should have actually moved away from unconventional policies. They didn't do it. The market will keep testing them now. But the big question then is, are we going to see permanently Japan inflation well above 2%? So even if it's 2%, then if the Bank of Japan actually has to do what George is saying, you start raising questions about fiscal sustainability, because there's no fiscal problem in Japan as long as the interest rates are zero. Once you start going to high level, you have to start raising these questions. And then depending on how this gets addressed, it could have global implications. We don't have in our baseline a permanent inflation problem in Japan, but where we're certain is that the low inflation problem is solved.
All right, because both of you have very interesting takes, because both of you saying there's something happening that's potentially very interesting in Japan. You're saying in one matter because of the, and I'm stretching here, because of the architecture of the market at this stage. You're saying it might not matter because of the temporary nature of what's likely to happen. Can you help us a little bit, Themos, here? Do you have, or if you can easily say it doesn't matter, let's move on.
I don't have a differentiating point. What I would say is it's not about inflation. There's very little inflation in Japan at the moment. And if you look at inflation expectations, it's not going anywhere. But Japan is in a very long political cycle away from Abenomics. It started in 2015. It was because the market was not functioning with QE. They settled down in the middle with this yield curve control. All of a sudden, the yield curve control is not working. They don't know how to abandon it, but they will ultimately, because the new governor will be in a very different place than where he was before. And in that sense, I think is an event that is mostly about the yen. The other thing I would say is that Japan has this habit in its history throughout the centuries to hop on to what's going on in the West very late and then get dragged into things in a very messy way. And the third thing I would say is that the yen has performed exactly in line with the euro. The yen hasn't particularly told you anything differentiated, which probably says that a lot of that is priced in and that the yen will do whatever yields do, which I believe in the US will continue to go lower. So dollar yen will continue to go lower.
Okay. All right. So I would describe then my Japan foray as move on. It's not really a real good show. How about China? And I'm shifting together because those are the two main suppliers of capital in the world still. What about China? Or nearly. With China, we'll see. But should I start with you, Themos, on China? Because you already told us a few things. I'm mostly thinking on whether it's one of those valves that kind of sealed us against recession globally and especially maybe in Europe. And what other sort of implications you think it has?
So if there's one thing that I'd like to impress on people at the moment, is just how important China is in general and how important China is at the moment as well. For some reason, tons of ink is wasted on the Fed, when the Fed, particularly this Fed, time and time again, has done exactly what the market has told it to do. So one can say it's endogenous in many ways. And very little analysis is done on the impact of China on the global cycle. China, if you just look at it statically, is about a quarter of GDP. Sometimes it's 40% of GDP growth. Okay? So it's a very large contribution to GDP growth in dollar terms. In PPP terms, it's almost half of GDP growth globally. And the links are not just trade. China is important for commodities. China is important for Europe, for emerging markets. It's important for investment. It's important for shipping. It's important for a number of things. China, at the moment, is having the deepest recession we have seen at least since the late 90s, basically, right? In some metrics, it's growing sequentially close to 1% growth at the end of the last year. In some metrics, consumption is actually negative, something which doesn't happen in China. This is despite the fact that China has been easing monetary policy for 6 months. And there's accumulated savings. China is in deflation because of that. This is a result of two things. First of all, what we all know as the lockdown, where not only did it affect sectors, it affected household incomes very substantially, but it's also a function of properties and how they have tried to control the property sector with asphyxiating measures. They're easing on all fronts. Our economist, who is among the most conservative economists in China, without taking into account the easing of the property sector, the easing that preceded the reopening, without taking into account accumulated savings or some kind of revenge spending pattern we've seen elsewhere, she's seeing an acceleration of China from about 1 percentage point sequential growth at the end of last year to above 7 in Q3. And I think that's conservative. Now, I don't think the markets have properly assessed that. I don't think that the dollar has properly priced it. No one wants to be long the Chinese currency. I don't think that commodity markets have priced it the least, energy in particular. And I don't think that people are pricing it enough in European or emerging markets growth. Perhaps emerging markets a little bit more than others, but not in European growth.
Everything else equal, how would you play that view in the markets?
Well,
is it an equity trade, an FX trade, or?
In our top trades, we have basically had various
Your preferred one.
Expressions of that. But I do think that, I have never seen a China cycle where equities start and finish at a third of the valuations that they were at the beginning of the tightening.
Okay, fair enough. On China, gentlemen, anything that you think it's worth pointing out or disagreeing with Amos? George.
So cyclically, I agree with Amos. I think we were so distracted by the Russia war and everything that was going on. In China, there were 3 things happening at the same time: COVID, the property tightening, and the war against tech.
Yeah.
So throughout last year, there was actually an active policy against bringing tech valuations down, and all 3 have turned. So cyclically, I agree. I think it plays into the European outperformance, the ECB versus Fed divergence. But the real big question for China is structurally what is going on. And last year, the US voted some very, very tight restrictions as far as chip making goes. And I guess this is a big question for Germany. It's a big question for the market. But one real implication we're seeing at the moment is essentially a parallel payment system that's being created between China, Russia, potentially the Middle East, around commodities, and diversion away from reserves, which maybe we'll discuss, leading to a lot of buying of gold, for example, as this divergence story is playing out. So cyclically, in some sense, we're seeing big convergence, but medium term, this divergence story looks extremely persistent, and I think has huge implications.
By the way, just to add to something that George has said, he said it in passing, but I think it's very important to emphasize it a little bit because it's understated. There's a real rift between the US and China, which in no way, shape, or form represents Europe, either its interests or its logic, let's just say. So Europe increasingly is facing a set of US policies that are challenging its own best interest. And it's not just with respect to China, it's also with respect to green transition and all that. So I think some big questions are being asked on what direction Europe wants to go with its own trade policy.
What's your best guess?
I think that these are all reasons why Europe, the big question is asked to Europe, do you want to invest in yourself? in your own defense so you're not that attached to NATO? Do you want to invest in your own energy sources and get out of this craziness about nuclear power? Do you want to have a more independent trade policy than the US? I think so far we have seen Europe that is moving slowly, but it increasingly is using common resources to address these problems. And that is another reason why I'm on the bullish end for Europe.
All right. Hanno, quickly on, if you don't mind, on China, unless you have something really important you think that we haven't covered, and then I'm gonna go a little faster because there are a couple of other issues I wanna get to.
I fully agree that China's reopening is a big deal. Historically, when China does well, the global economy does well, risk assets do well, the dollar weakens. This time might be different because of high inflation. So the more positive the impact of China on growth, the more it will add to inflation pressures at a time that the labor markets are very tight. And to the extent that headline inflation now is coming down because of the drop in energy prices, China's reopening will put new pressure on energy prices. So my concern is that we're going to have overheating pressures because of China, which will force central banks to tighten policies more. So on balance, this time, it might be different. It may be risk-off because it will be much more difficult for central banks to fight high inflation.
Would that be a bit different if the renminbi gets appreciated in the process, a bit more significantly?
Yes, but I'm not sure if the Chinese authorities want this really to happen because, again, the economy will recover fast because of the reopening, but there are weaknesses in the economy that a strong currency is not necessarily something that, they would like.
Cool. Let me just, because I think it might be relevant to a number of the people who are investing or are exposed there. I think all of three of you still live in the UK. It's been a very idiosyncratic story as of late. How does this translate? Is it gonna stick out in 2023? And how about the sterling? Is there a big trade there, or is it all priced in? I'm gonna start with you, Thano.
In the short term, sterling has been doing well recently. In the short term, there may be some upside because they seem to be moving towards a compromise with the EU, the Northern Ireland Agreement. The polls also, for the first time, suggest that the public has finally realized that Brexit has been a mistake and the way it has been handled has been horrible. But beyond some short-term strength, we are concerned about the medium-term to long-term outlook. Obviously, the UK keeps doing one policy mistake after another, but the macro mix in the UK is more or less the risk scenario we're concerned about the rest of the world on steroids, because today the UK has the highest inflation rate in G10, negative GDP growth, and the lowest unemployment rate ever. Obviously, to a large extent, this is because of Brexit-related bottlenecks, but because of these labor market shortages is a big part of the story. And the Bank of England is stuck. They are hiking, but they try to be dovish. So the macro policy mix is very difficult. So if we do get a rally in sterling because of another Ireland deal, that might be an opportunity to sell.
Okay. George.
You mentioned one interesting thing, that sterling's idiosyncratic. And I would actually make the opposite argument. If you look at sterling last year, it's behaving, people say behaves like an emerging market currency. The definition of an emerging market currency is extremely reliant on what's going on globally. And if you look at the week, we had the fiscal crisis. Who would have thought we've had a fiscal crisis in the UK? Global equities were collapsing at the same time. You had upside surprise to US inflation, rates were going up. And the UK now, as a twin deficit country, extremely reliant on foreign capital. So the Prime Minister picked possibly the worst week ever to announce a need for more money from foreigners, and foreigners said no. My hypothetical prediction is if she was still in power and made that ask today, actually nothing would have happened, because now the market is willing to provide capital because of risk on and China reopening. So I guess my main message, sterling is very much externally driven now. The irony of Brexit was meant to make the UK more independent. It's actually more dependent now on foreign capital. The vulnerabilities have gone up. But when we look at the structural trends, The Economist had this cover magazine, UK, the New Italy, I was going through my Twitter account. It upset both the Italians and the British, but the dynamics look similar. If you look at capital expenditures after COVID, in Italy we had Draghi. Italy is booming. In the UK we had Boris Johnson and Brexit, extreme underperformance. So the structural underperformance, structurally higher inflation, and how do you gain competitiveness? You devalue the currency. So the medium-term forecasts we have are negative.
Okay, sell, long-term, okay.
We were long, Sterling.
All right, good. Now we're in business.
We are a British bank after all. No, I think that I respect the views that I've heard, but I think that there's something we need to take into account in the near term, that, and Thanos hinted at it, that the Bank of England took a bet. They said, well, look, for all the reasons that, that George said, activity is not doing that well. Of course, they didn't want to admit that some of it is because of Brexit and it's inflationary. They said that the shock to prices will be self-correcting. We will have a recession, price will come down, and we're not going to need to raise rates so much. I think this was, the experience of what has happened is the opposite. The economy is still flat, it's doing nothing, but it's definitely not having a recession. It's flat because there are no resources because of Brexit. The prices are going through the roof, and it's not just goods. Service inflation recently prints near 7%. And the Bank of England has run out of excuses because what they called as an imported shock has actually reversed. So I think the next couple of meetings, together with the ECB, they're going to be sending some very hawkish messages.
So there's a surprise coming.
And I think that particularly in the UK, you should have the most inverted curve in the planet. A lot of hikes coming with a lot of cuts later, basically.
All right. Cognizant of time, and I want to give kind folks here a chance to ask the questions. I'm just going to definitely pick one, which is I'm going to ask you about something close to the hearts and the portfolios or the exposure of many here, which is Greece. And you can talk about the periphery in that context, but how should we be thinking about Greece here? Any sort of assets? Is it truly a differentiated story? Does it matter, or is it something to look at in a different way? I'll start with George.
So I'll give you an
He's long
anecdote.
Thessaloniki.
Khalkidiki. I'll give you an anecdote. I was in Sweden last week and in Stockholm. Everyone is depressed. House prices are down 20%. Here, house prices are up 20% over the same period. So you have a 40% difference.
They must still be depressed about that because they were looking to buy. But go on.
But rates have gone up the same in Sweden and here. So why do we have this difference? The reason is, if you look at the loan to deposit ratio in Sweden, it's nearly 200%. Here, it's the highest in Europe. Here, it's 60%. No one has loans. The last 10 years, everyone's deleveraged. So strength number one for Greece, no lending, very, very low private sector leverage. Everyone is fighting the last crisis because they're looking at public debt, but the relevant metric is private debt, very low. FDI increasing, structural reforms materializing, and EU funds that are 3 times as large as the Marshall Plan. When I look at the combination together, to me, it looks like it ticks all the boxes of a textbook sustainable recovery. Political stability is the thing that needs to be assured. But I am very positive.
Well, what does it mean from the perspective of the clients that you speak to? Do they ask about Greece, and what do they think, or what do they ask you about how do you think they're thinking? How are they functioning with that political risk right now?
So I think Greece's biggest problem is actually people aren't asking those questions because Greece has not yet, and maybe this goes into the investment grade, increasing the number of companies in the Athens Stock Exchange. Greece is yet not perceived, wrongly, I think, as a big investable country asset class. So I think a big challenge for all of us for the next 1 or 2 years is to advertise Greece, highlight where the investable opportunities are. because it's just people haven't been focused on the story. The only people that are focused are the specialists that have been following it for the last 10, 15 years and are finally making returns. But the breadth is not still high.
All right. Similar question to you, Thamos.
So Greece is one of our top trades for the year. The unfortunate bit, as George said, is that for a global investor, there are not too many investments that they can put a lot of money in, as much as the Greek bonds. So the Greek bonds are what we have expressed it through, but I'm pretty confident that for investors that can take the risk, there's a lot higher beta investments in riskier assets in Greece. Where do I start? The starting point is so low, not just in leverage, but in actual output. The structural reforms that happened during the debt crisis are paying off. The most notable example is the impact that local airports have done, the privatization of local airports, local ports, etc. The public investment plans are of ginormous levels. If you look at the credit components, it should be as tight as Portugal, but it's 100 basis points wider. Everyone's talking about a political risk, but if you look at most polls, there's no alternative outcome that doesn't involve a party from the center in it. So the outcomes that we saw at the onset of the crises in Greece are impossible arithmetically at the moment. And I think that beyond that, I was reading some very, very interesting history book recently on Greece, and Greece is going through these cycles very frequently, and it feels that this is the beginning of a new mega cycle for Greece. So I think that it's a very interesting story.
And how about the clients? Do they care? Do they ask? Are they invested?
Interestingly, my experience with clients, probably because we have a bit more focus on credit, is one where they are looking at Greece. And I think they're looking primarily at the yields of corporates, particularly short-term, offer very substantial pickup and pull to par, basically, right?
All right. Panos.
I fully agree. We're very bullish on Greece. But as Themos said, whenever historically Greece went through a mega cycle, it ended up in a disaster. So I'm asking myself, what can go wrong?
He's the cheerful guy in the company.
So, we do expect faster growth in Greece than the rest of Europe. The money from the NGEU is really huge. But if we end up in a scenario in which inflation in Greece is higher than the Eurozone and you end up with current account deficits, you have a problem. So from this point of view, how they're going to spend the NGEU money is extremely important. They can spend it in productive investment that will increase potential growth, the export capacity of the economy, and then you're talking about a long-term bullish scenario, or it is wasted, it is spent in something that is not really investment, it's consumption, unproductive projects. They actually end up increasing the current account deficit, and then this leads to problems at some point in the long term. So the NGEU money is extremely important, but how it will be spent, I think, will determine what happens.
What are your probabilities?
I like what I'm hearing from the government. I like what they have on paper. We'll see in practice. Definitely the plans are in the right direction.
Okay. All right. Let me take a pause because we have maybe 10 more minutes at most for some questions because somebody has to catch a plane. And let's maybe hand the microphone if anybody wants to lift their hands, and we'll get you a microphone on anything that you heard that you want some more explanation or something that we didn't cover that you think is well worth asking.
Or it's something that you disagree with.
Well, mostly a question. Forget about it. Greeks will always disagree about everything, so let's not go there. Any questions? Please. Can we get a microphone?
Also happy in Greek, happy to answer.
Yeah, and yeah, if you specifically you have a trouble in English, go ahead in Greek. I'm just teasing you.
So my question is on the Russia-Ukraine war. What is the base case that you use for your forecasts? And if there is a much faster evolution for whatever reason, what is going to happen to the forecast, both effects and inflation?
Who wants to take this? I'm going to force you. 3, 2, 1, Thanos, go.
We ignore it in our forecasts, and the market also ignores it, up to an extent because it is very difficult to have any baseline assumptions. What is certain is that the sanctions are here to remain, but we just don't know whether the war will escalate and whether this can happen next month or in 6 months or in a year. So given this, you just choose to ignore it, but it's a major known unknown. And obviously, if things go wrong, it's major risk off. It's more negative for Europe than for the US. I'm also concerned because part of the reason that energy prices are falling is that the sanctions, there are so many ways around it. I don't know to what extent this is sustainable, but definitely it's a major risk in which nothing is priced at this point because it is very difficult to price anything.
George.
So the biggest transmission mechanism of the crisis has been gas. So I think we have to start from that. German gas storage is 90% and it's January. So we think even if you get a cold winter, it looks like it will still be warm through February. Germany will be able to refill the tanks by June. If you think about last summer, we were paying 40 billion euros per month for gas to Norway, to the Qataris. It's very possible now we pay zero because everything is just filled up so quickly. So the relevance of the reason Thanos mentioned the market's ignoring it, I think one reason is the gas is full. And this also provides a buffer for next winter because even if it's very cold, there's only a few weeks left. When will Russia-Ukraine matter again? I would say if it's outside of Ukraine, if you get an attack on a Norwegian pipeline or you get NATO involvement because of a nuclear weapon, something very extreme. But at the moment, the market is focused on the gas situation, which looks very good.
Okay, Themos, anything to
I
add?
don't have something to add on that. What I would say is that because we always look at the previous big story, I think one needs to look a lot at Iran as the next big story. And that is where I am more focused on the geopolitics and the risks there. But that's for a different.
Well, it was a question if we had time, but since you mentioned it, what's so interesting about Iran?
Well, lots of things are happening. First of all, it's pretty clear that there's we need to be careful because we're also live, but it's pretty clear that there are ways in which Iran interacts with Russia. It's pretty big debate about the nuclear plan of Iran, which is coming to a very big point. There is a pretty big antagonism between Saudi and Iran happening at this time in a proxy war in Yemen. Daily risks of disruptions at the Straits of Hormuz, and an Iran which within looks to have a lot of factors of instability. So given its importance locationally with Russia on oil and on natural gas in some extensions, I think it's something to keep a very close eye on. I don't know how it's going to play out, but it doesn't seem like a place that people should not be looking at.
All right, if it's underappreciated on all three of you, it's an interesting geopolitical thing to mention. How would you recommend that people play that in the portfolio? Acceptable answer is don't play it. But if you were to add something to say, okay, maybe I got here an interesting.
I think for me, it's the risk of higher energy prices. You have Russia, you have China, you have, the strategic petroleum reserve no longer being eased. There's a lot of reasons to think that we're not going to go lower, and the curve is still pricing lower oil prices. So I think that I'm with Thanos on that one.
George?
There's too many things going on in the world, so I don't focus on Iran as much. So
No, I'm just saying conditional something like that flaring up. What's the right trade to have?
What's the right trade to have? Yeah, I would agree energy. And the transmission of the current geopolitics is working.
I thought you were going to say gold because you mentioned that before.
Gold is an interesting one because I think the dollar will go down, but I also think real yields will go up. And gold does not do very well when you
Okay.
can get yield elsewhere.
Panos?
I think will contribute to sticky inflation, will be risk off, because it will be yet another geopolitical development that there's no easy way out and can escalate.
And what will do well among the things that you like already?
In these cases, the dollar always does well. It's a,
All right.
I'd say, heaven. So yeah, but it will add such risks. It's yet another force that contributes to sticky inflation, risk off in a market that is just too complacent at this point.
Okay. Any other questions? We have one at the back over there, sorry. I'm just going to probably finish with you. You'll have a chance with, yeah, please go ahead.
It is a pleasure to have the Dream Team panel, and there is always $1 million question for the Dream Team.
Go for it.
I suppose you guessed. Has the US dollar peaked, and if not, when it will peak?
Fair enough.
Thank you.
Start.
I can start. Although I'm bullish on the dollar in the short term, I do believe that we're not going back to the peak we saw last October. You need something really extreme for this to happen. I mean, if inflation starts increasing again, or a major risk off. So our baseline is you see some renewed dollar strength because of risk off. And then in the longer term, would you agree that the dollar will weaken because it is overvalued? So yes, the dollar peaked last October, but maybe it has weakened too soon.
George.
If you think about last year, everything that could go wrong went wrong. You had the biggest war since World War II, you had the biggest shutdown in an economy in history, and you had the biggest inflation problem and the biggest central bank tightening. And that's why everything went down. And the only thing that went up was the dollar as a safe haven. So yes, it has peaked because it's going to be very difficult to repeat everything. And I guess depending on your optimism, we debate the pace, which is what we do. But I think, yes, we're in line.
I'm with George on that.
Sorry?
I'm with George on that one.
You're with George. Yeah, just for less than $1 million, you got your answer. It's fairly consistent. One last question because we really need to get to the airport then.
Yes, I would like to ask you in regards to the central bank put, is still intact? What do you think?
I think that's one of the reasons that I'm bearish equities and bullish on the dollar in the short term, because the market is still pricing a central bank put. The fact that bad news is good news, you get weak data in the US, the dollar is down, yields are down, equities are up, suggests that the market still expects the Fed to come to the rescue. If inflation indeed is sticky, and even if it's not sticky, as long as inflation is well above 2%, the Fed is not going to come to the rescue. We have seen it with the Bank of England when we got the LDI crisis. They stepped in just to make sure the market will function, but they did nothing else. So that's one reason why I believe that equities are too complacent at this point.
No put. Go ahead.
If there's one thing I've paid the most dearly in my career when I was also investing, was to think that collectively markets are stupid and I'm smart. And therefore, I always try to understand what the markets are trying to say. And I think that what the markets are trying to say is that if inflation falls, so if the last 3 months is anything to go by, even in moderation for the next few months, then basically the Fed put is going to come back on the table. And what is currently a Fed that is actually trying to use the market to bring inflation down, they're expressing their frustration, they want financial conditions tightening, they're adjusting their language to make sure that stocks are down. The reason why stocks are up is that if inflation is down, all of a sudden, it's only about growth. And if it's only about growth, then policy, growth, stocks, they're all hand in hand. So if inflation declines, it's a sea change in the risk profile of assets. and the assets are pricing some probability of it.
George?
There is one central bank put, BTPs in Italy. If the ECB hikes
Too much.
too much or tries to hike, it will not allow Italy to blow up while there is a war happening in Russia, Ukraine. So, of course, BTP Bund is at the tights, it can go at the wides, but that, I think we can feel a bit safer.
All right. So look, we really have to end, but he's my chairman, so he gets the question. He gave me the nod. So quickly, chairman.
That's a good point.
Promising that they will tighten. To me, this is critical. Is that in the horizon, or is going to be just
Talk.
talk?
Talk or QT? Is QT binding?
I'm happy to take that one. I think that we're finding out that QT is not the opposite of QE. So while QE was working in a certain way, there's a very good article that was written by Raghu Rajan that said that the financial system adjusts to the surplus of cash. So what you have seen in the US is that as they tighten money supply, instead of draining cash from all the places that they want to drain it, money market funds, etc., they're draining it from cash reserves, and it's very likely that's going to cause money market problems sooner than they thought. In Europe, they're worried about it, and they've introduced a backstop particularly for that. To me, I think that every central bank has gone out of their way to emphasize that the primary tool is rates. And if anything interferes with rates, they're going to stop that. And vice versa, they cannot substitute rate hikes with quantitative policies. So for me, QT is the question of whether an accident happens because of QT and how quickly it gets resolved. But otherwise, I don't think anyone is convinced about how it's working or what's the benefit.
Maybe
Yeah.
one small point.
You're the one who has to catch a plane, but go for it. Yeah.
Every central bank in the developed world is either doing, like the Fed, or has announced. So every central bank will be selling government bonds. There is only one government bond market that will not suffer from QT this year, GGBs.
GGBs, if you didn't hear that.
Because the ECB never bought them. And again, to maybe finish on a positive note, this is another source of strength.
On that very positive note, thank you very much, guys. We're really appreciative that you came all the way here. Thank you.
Thank you.
Ευχαριστούμε πολύ. Ευχαριστώ πολύ.